Good morning, everybody, and welcome to this mid-year webinar series. So how's it going in 2023? Mid-year is always an opportunity to look back on the progress that we've made and the experiences that we've been through, and to look forward to the way in which markets might perform for investors. And that's the focus of this week's webinar series, starting today with Monik Kotecha from Insync, Hamish Tadgell from Hiscock, and the whole week moderated by Creighton. Brad is a portfolio manager for AMP Investments, the investments arm of AMP Wealth and the AMP Group. And I'll leave it to Brad to introduce our presenters in a moment or two. But before I do hand over to Brad, I'd just like to say a little about some of the work which we've been doing within IMAP, particularly around high net worth area, where last week we ran a webinar series on a study which we've undertaken with a number of participants on the high net worth market and the way in which different types of organisations serve that market, and the role that managed accounts, if any, has in that service. We'll be publishing a white paper from that and running a masterclass in association with our Advice in Action conferences next month in Sydney and Melbourne. So next month, Advice in Action, our advisor-focused conference series, will be in Melbourne, Sydney and Brisbane, and I'll run through in a moment the types of topics which we'll be covering. And then looking further out in September, our Independent Thought Conference, where we bring together around 30 portfolio managers from a range of different organisations, asset consultants, licensees, and investment managers, to see how their view on markets at that time is shaping the way in which managed account portfolios are being constructed. So at Advice in Action, this year the theme is sustainable business models for advice. And you can see on the screen the range of topics which we'll be covering. At a time when we're experiencing the changes that the Quality of Advice Review will bring about in advice, some of them positive in the reduction of red tape, others less positive in encouraging competition and perhaps a murkiness about what advice is and the scope of it. We'll be examining in a number of sessions, largely presented by advisors and practice principals, the way in which they're thinking about building sustainable business models for advice. So how did the managed account improve my business? What does a sustainable high net worth offer look like? How to talk to clients about ESG, earning tomorrow's clients. As you all know, intergenerational wealth transfer is an enormous opportunity for the advice profession, but one which is fraught with difficulties. A practice management and business strategy, what licensees have to do to continue to offer their own portfolios, such an important part of the managed account environment, and ways in which advice practices can differentiate their service offer. So that's the first part of the day for Advice in Action. So breakfast through to lunchtime, and then we'll be running a 2-hour masterclass with a number of leading organisations for whom this is a primary or significant focus for their business. So organisations like Findex, Centric, like JB Ware, like Shaw and Partners, will be talking about these 4 topics: managing the compromise between high service and high efficiency, serving family offices. Jana will talk about that. A high net worth client's investing needs different, and structuring to serve high net worth clients. So I'd encourage you to attend Advice in Action and the masterclass in Sydney and Melbourne. On Wednesday, Brad will be moderating the fixed interest session with Jonathan Costello from Western Asset Management and Alex Cousley from Russell's. And Friday, we'll be looking at that other increasingly important part of the advice environment, physical assets and infrastructure, with Mary Power from Jana and Shane Hurst from Clearbridge. Now, I hardly need to tell you how to ask a question, but of course, we encourage you through today's sessions to send those questions in, and the presenters will deal with those as we go and at the end. So now it's my pleasure to hand over to Brad Creighton from AMP to moderate this week's session on how it's going. Thanks very much, Brad.
Thank you, Toby. Hi, everyone. I'm proud to be representing AMP and the North platform as your moderator today. I'd like to start by sharing some information with you to contextualise the session. I've analysed a hypothetical 70-30 growth portfolio comprised of Australian and international equities and government bonds going back 30 years. 2022 was the third worst performing year for that strategy, followed by 2002 and 2008. It marked one of 5 periods of portfolio drawdown greater than 10%. However, in the 12 months following prior drawdowns, the portfolio recovered, and it recovered by an average of 15%, driven almost entirely by equities. So far, in the first 6 months of 2023, this portfolio has recovered by 7%, broadly on track with the 15% trajectory seen following past drawdowns. But the journey in 2023 has been anything but straightforward. One aspect, out of lockstep with history, has been the influence of tech stocks. By way of example, the Nasdaq has outperformed the S&P 500 by some 19%, close to the widest margin observed since the tech bubble over a 6-month horizon. And from a macroeconomic perspective, the recovery in global equity markets has been at odds with expectations for a recession. At the heart of the argument for equity bears is that inflation has caused borrowing costs to rise for consumers, businesses, and governments alike, and that inflation itself is sapping demand for everyday goods and services. Recent global equity market leadership has also been comprised of a very small subset of tech names, with comparisons being drawn to the tech bubble. The bulls see a resilient consumer, allowing businesses to pass through higher input costs and pay higher wages, while at the same time increasing their profit margins. Corporate balance sheets, they say, are generally in good shape, having secured cheap funding in prior years, and governments seem eager to foster growth in an age of digitisation, disruption, and intensifying geopolitical competition. So it's now time to hear from our experts and the trends that they see shaping the rest of 2023 and beyond. Monik Kotecha is the CIO of Insync Funds Management, possessing over 30 years' experience in global and Australian equity markets. In 2020, Monik was recognised as Money Magazine's Emerging Fund Manager of the Year. Hamish Tadgell is a portfolio manager at SG Hiscock. Hamish was the CIO of Goldman Sachs' Australia and Global Research Division, and his career spans 24 years and counting. He is currently the portfolio manager of 3 SG Hiscock's equity funds: High Conviction, Small Companies, and X20 Australian Equities. Monik and Hamish will each be giving a 15-minute presentation, followed by Q&A. Monik and Hamish, I must respectfully stress the 15-minute time limit to allow for sufficient Q&A time. Welcome to you both. Monik, I'll now hand over to you.
Great, thanks, Brad, for that. Providing some context, because I think that's a really useful as I go through some of my thoughts about the markets going forward and where we're going in terms of future returns. At Insync, our focus is very much on finding businesses with sustainable earnings growth. And I think this chart really depicts the main reason why. So this is a chart of the S&P 500 going back, well, it's a very long chart. It's a 150-year-old chart. The blue line is the S&P 500 price movement. The red line is the earnings, and the green line is basically the valuations. Now, what you notice here is that over time, valuations do shift around significantly, but the real correlation really lies between the share price and the earnings growth, and you can see there's a very tight correlation there. So, you know, if we can find businesses that deliver sustainable earnings growth, we believe the share prices will follow that over time, regardless of general market conditions over the short term. So in terms of how we go about identifying those companies, there's basically two key aspects to finding businesses with sustainable growth. One is finding really, really high quality businesses, and these are companies that are really profitable. The way we measure it is return on invested capital, high net margins, high gross margins, very little debt, generate huge amounts of cash, and some of the most profitable companies out there. And then they need to have a long runway of growth. And the way we identify those runways of growth is looking to see if we can find some mega trends, and then that really offers those businesses that are positioned in that mega trend to really deliver the growth that we're looking for. So it's not only about growth, it's also about really high levels of profitability, and both of them have to be in place for it to be in the Insync portfolio. So Brad's created some background, which I think is very useful, because 2022 was clearly a tumultuous year for markets. We know why, all the reasons why. And going into 2023, the general market consensus was incredibly bearish, the reasons were clear. We've had the fastest increase in interest rates, I think, in history back in 2022. So there's concerns about the impact that would have. Obviously major geopolitical tensions, obviously the Ukraine war, which is clearly very tragic and ongoing, and that created particularly some issues on the commodities side of the complex, and obviously fed through into inflation numbers in the short term. And obviously, and China is obviously the other big one. And importantly, obviously, the impact of interest rate rises on the broader economy and the earnings recession. And I think really when it comes to equities, as I said, it is all about earnings, and investors, particularly a lot of market pundits, were very fearful about what earnings would do in 2023. And as Brad said, when you go through a very tough year, investors are typically very bearish, underweight equities, hold high levels of cash, and typically the year following a really bad year typically tends to be a very good year. So it's very counterintuitive. So let's focus on earnings for a second. And this chart's useful because it basically talks about what expectations on earnings have been in 2023, which is the red line, and in 2024, which is the blue line. And you can see that back in 2022, before rates started going up, that investors were, a lot of market forecasters were extremely bullish about earnings into 2023. And at one stage, earnings expectation was around $250 per share in the S&P 500 in early 2022. And that's obviously come back significantly. And likewise with 2024. So if you look at the 2023 number now, it's about 221. And interestingly, that's broadly in line with what we achieved in 2022. Now, in a typical recession, earnings typically fall by 10 to 15%, and we haven't seen that yet. And if you look at that chart, you can see that earnings are actually starting to base and actually starting to curl up a little bit. So now, forecasters are starting to get a little bit more positive about markets going forward. So I think that the takeaway there is that, the earnings recession was already discounted in 2022. The market tends to look 12 to 18 months ahead. And so whilst investors were very fearful, as I said, the markets are a discounting mechanism, and they really missed, I suppose, the fact that earnings were probably starting to base and likely to improve in the subsequent years. If you look at the other big feature concerning markets, it's obviously been inflation, and obviously the Fed's coming to grips with how to manage it. And this is an interesting chart because I think it shows various periods of high inflation going back over the last sort of 70 plus years. And an interesting feature of this is that the way inflation works through the cycle is actually quite symmetrical. So if it actually rises very quickly, then it tends to fall very quickly. And if over time it rises very gently, it also tends to then take a little bit longer to get out of the system. And I think if you look at the inflation that we've gone through, it's actually happened very abruptly and very quickly. So if history was any sort of guide, then it would certainly suggest that there's a reasonable chance that inflation will start falling pretty quickly at some point during the very near future. And that's certainly coming through in the data at the moment. This is the US inflation stats going back to only 2017, because I think through that decade, it was obviously pretty stable and low. And then we obviously saw that surge in 2021 and 2022 come through. And you can see that if you look at the white line, it peaked and it is now starting to come off. And likewise with the dotted white line, which is the core inflation, it takes out the more volatile components of inflation. And whilst the services area has been a little bit sticky, the trend is very clear, which is that inflation really is on its way down here. If you go to the next slide here, and if you look at, there's obviously, you've all read about the very negative case for equities. As I said, if you look at most data, most investors are very poorly positioned in terms of participating in the current recovery, be it a 70-30 portfolio or just in equities per se. But there is a positive case here, which one needs to sort of reflect and think about. As I said, inflation is starting to come down. The economy appears at this stage less likely to go into recession, and particularly if the Fed's pretty close to having maybe one more interest rate rise at most, possibly. So we're getting towards a peak in rates. And so they're certainly becoming less hawkish. And I think the other big feature, which has been the big driver of markets, and it is real. I mean, this isn't just a bubble. I mean, NVIDIA announced, $5 billion extra in revenues coming through the chip business this year from nowhere. So that's real revenues, real earnings, real cash flow. And a lot of investors were caught out because they were too busy looking at the macro and concerning themselves and not looking at what was actually going on with the businesses and how they're actually performing. And I've got some good examples just to show you that a lot of businesses actually have continued to deliver very good growth through this period. So in terms of Insync, just, as I said, we tend to focus on secular megatrends and companies with high levels of profitability simply because, we don't have to concern ourselves as much with what's happening to the cycle. These, megatrends tend to be a lot less sensitive to economic cycles. They tend to be very long-term durable trends. Got lots of examples here. You've got the aging of the population, which is the silver economy, all the way to obviously pet humanization and the adoption of pets, which has been accelerating over time towards low carbon emission, enterprise digitization, artificial intelligence. All of these are secular growth trends that are not really being impacted by what's happening to interest rate policies and economic cycles. So just to give you a few examples, as I said, I think investors have been too focused on the top down and clearly cyclicals are a difficult place to be because you have to sort of time the cycles. But when you look at the secular growth companies, and an example I provided here is Equities, which is the leading provider of medication and vaccinations to the pet industry. You can see here that when you look at the sort of the purple line, that's earnings per share. And, that's sort of been, had a bit of a dip obviously during COVID, and then it's been trending up over time. And yet during that period, the share price has gone down. So there's been a major disconnect between earnings and share prices. And our view is that as investors start to refocus on earnings again, that share price will come back up to meet the purple line. The other interesting feature on this chart is that their earnings today are actually higher by 40 to 50% compared to where they were in 2019. So, earnings have continued to power ahead regardless of economic uncertainty. And you can see here why, because obviously the key driver is pet expenditure. This is a chart going back some 20 years. And you can see that there's been steady growth in pet expenditure on an annualized basis of 6 to 7, 8% per year. And it's actually accelerated in a post-COVID environment because pet adoption is actually accelerated. So again, very little sensitivity to the economy. And Zoetis is, as I said, a very highly profitable company, very little debt. So, it just continues to power ahead. Another example, Louis Vuitton, again, very similar. You can see the purple line is the earnings per share, has continued to trend up. And here's an example where investors have recognized that, you would have missed out if you were out of the market and busy worrying about, the extent and depth of the recession. And there are companies out there that are delivering very strong earnings. And you can see the share price has moved up to where the earnings per share is. And again, likewise, it's a secular growth industry. It's a mega trend industry. It's growing well ahead of GDP and has done through all periods in the economic cycle. And then just finish up with the last example here, which is Adobe. Obviously the buzzword at the moment is AI, and it has taken off in a very meaningful way. There's 1.3 billion users of ChatGPT, so there are more users of ChatGPT than there is in Reddit or Netflix today, in a record period of time. So the adoption's accelerating. Adobe is a clear beneficiary of that. They're sort of the what we call the content creator kings out there. If you wanted to create anything on the website, you really need Adobe tools. There is no other option out there. And again, you can see here that the share price has got hit quite hard last year. As interest rates went up very quickly, but the earnings continue to power ahead. So if you remember the earlier chart I put forward, there is a close correlation between share prices and earnings. So you can see now that as earnings continue to move ahead, the share price is slowly moving its way back up to where the earnings are moving towards. And there again, you can see looking forward here, the digital transformation market, every company has to spend on technology. Every company has to spend on cloud computing, on artificial intelligence to stay competitive, to stay ahead of the curve. If you look at the size of that market, it's expected to grow, in excess of 20% per annum over the next 7 to 8 years. So regardless of, what Powell's going to do next in the US or what Lowe may do in Australia, the spend on digital transformation will continue to move ahead significantly. And companies like Adobe are very well positioned to take advantage of that. So just in conclusion, clearly, interest rates have gone up, and I would agree that there is still some residual earnings risk out there for some companies, particularly those that are more economically sensitive. But having said that, there are a lot of companies out there that are benefiting from those mega trends. They are very high quality. So these are unprofitable growth companies. They're actually very highly profitable, sustainable growth companies. With all those value, with all those quality attributes that sit behind that. And we do firmly believe that in this period of uncertainty, that is certainly a good place to be going forward. So with that, I thank you and pass it back over to Brad.
That was fantastic, Monik. Thank you so much. I look forward to the Q&A session. Some of the things that came up in your presentation extremely interesting, and I'd now like to hand over to Hamish.
Thanks very much, Brad. And again, I think your comments at the outset are very apt and certainly feed into some of the things that I'd like to talk about. So just turn to the next slide, please. Right. So I've just got 2 slides today. And the first one, well, the key point that we're really making, I think it talks to what Brad spoke to, is that we think we have been navigating quite a narrow market, and we think that it's going to be quite an uneven economy going forward. At a big picture level, we think the world is changing. There is certainly changing demographic trends, but in addition to that, rising geopolitical risks that we've seen and tensions we've seen. And we've also seen a big shift in terms of disinflationary to inflationary trends, being driven not only by those geopolitical risks, but I think also things like the energy transition, shift to decarbonisation. They are inflationary. What we're seeing with that is a shift from cheap and plentiful and scarce labour, in our view, to a world of more expensive labour and more expensive energy. And that's a result, I think, of some of the structural changes that we've seen and geopolitical changes that we've seen, war in Ukraine, and again, sort of decarbonisation trends. And in our view, that's also feeding through into a deglobalisation, or more of a shift to regional alliances, and with specifically a focus in a lot of cases on tariffs, which we've seen, but also supply chain resilience. And we've seen a lot of nationalisation of certain resources in particular in response to that. What that rise in inflation is seeing, and the interest rate changes we've seen, is clearly we've seen a shift in the rising cost of capital over the last 12 to 18 months. And that is seeing a reassessment of valuations and liquidity, of credit flows, and we think changes in behaviour in the way that investors are reacting. And also, in addition to that, increasing tail risks. So we've seen crowding in certain parts of the market, and with over a long period of time where we've had a deflationary trend, deflationary cycle really for the last 20 to 30 years. And we're now starting to see some of the consequences of that crowding as cost of capital and interest rates move. And we expect going forward that there will be further tail risks that eventuate. Predicting them is incredibly difficult, but it's something which I think you've got to be conscious of in markets. So the rise in inflation we've seen, and the interest rate moves and the tightening from reserve banks is leading to higher rates, and that is having different impacts across the economy. Clearly, rate pain is being felt most acutely here domestically and in the mortgage market, but some parts of the market and consumers won't feel that pain nearly to the same degree, and that means that I think we're going to have a very uneven impact across the economy, and I think that is also going to be felt. That unevenness is going to be felt at a sector level and industry level as well. One of the things over the last 12 months, last 18 months, I think people have been calling for a recession. It's probably been one of the most best telegraphed recessions. Whether it actually eventuates is a question. And a lot of that has been driven by the fact that labour markets have remained incredibly tight, and unemployment has remained very low. At the end of the day, we need to remember, I think, that the Reserve Bank is, by raising rates, really trying to destroy demand. And as whilst people have got a job and while consumers have had the savings buffers from COVID, that impact is taking a long time to kick in, or there's been a long waiting game, I guess you might say. We think over the next sort of 12 months that financial conditions are starting to appreciate and will starting to tighten, and will tighten further. And with that, we're going to see increased pressure around earnings and margins, particularly in the more discretionary type sectors. And we're already starting to see that clearly in some of the discretionary retail, hospitality, and the construction sector. So the question is, how do we play this? How do we set the portfolio up in an environment like this? And there's a number of themes and I guess tailwinds that we're focused on. Firstly, we think that inflation will be more persistent, and that will benefit certain sectors, particularly like insurance, which benefits from not only the hardening rate cycle, but also improvement in technical reserves and profits. We also think that there is the reopening and surging migration. Reopening, I'm referring to clearly COVID reopening, which is, I understand, been happening for quite a while, but there are certain stocks which were more impacted, and our later cycle reopening plays, which we still think are beneficiaries. CSL is a very good example of that in the plasma environment. So I've just lost the slides there. Is there? Thank you. Another theme which we really like is the energy transition. We think that this is a secular theme which is not economically sensitive. And we're seeking to play that through a number of different ways, which I'll show you in a moment, through the supply chain from the producers, the lithium type players, right through to the service providers. Finally, we're very focused on essential services and infrastructure plays, and this incorporates a number of different sectors and companies, particularly around sort of fibre, data centres, the data, healthcare, etc. If I could just turn to the next slide, please. So just in terms of portfolio implementation and how we're playing some of these themes and how they're feeding down, I'd just like to go through that in a little bit more detail. So as I said, one of the things that we really like on the persistent inflation is the insurance. We have positions, we think that insurance over the banks is the way to play at the moment. The domestic banks were certainly beneficiaries in the last 12 months. But we think the headwinds for them are increasing, particularly around credit growth, competition, the cost of funding. Defensive consumer is an area we're also like. We're very, we've got, I guess, concerns around the sort of discretionary side, as I've talked to. But Endeavour Group, which plays in the sort of the beverage market or the alcohol, mainly through Dan Murphy's, but also through its pub franchise, is an example of a stock which we think has got good defensive characteristics in its environment. The other thing which we think is got a position in the portfolio around is gold. We think gold is an important hedge, particularly in a higher inflation environment. Around the reopening and migration thematic, I'll just call out student immigration is an area which we particularly like. We think Australia has been very good at exporting education. IDP is an example of a stock in that space. It also has strong franchises in the UK and also in Canada. But I think last week we saw the announcement with Modi and the Prime Minister around student immigration from India, but also the reopening of China. We've seen that that feeding back into higher student numbers here. The housing undersupply is an interesting issue, and I think clearly we've got a rental crisis. It's something that's feeding into the higher inflation here, and it's an area which we are very interested in at the moment. I think the government is clearly trying to put some stimulus in place. There is a bit of a quandary, I guess, around where house prices might go with higher rates and the structural undersupply. But we think at the end of the day that more houses are going to need to be built, and that will certainly benefit the likes of Mirvac, James Hardie. Just on the energy transition, I just really want to focus, just as I said before, a number of different ways which we can see that you can play this, but Infratil is an interesting play in that it's has a long roads business in the US, which is a big renewables business that it has. It also happens to own Canberra data centres as well, so it's a bit of a play on the sort of the data centre thematic and big data, cloud, and AI as well. The critical commodities, we've been very focused in terms of those that we like. We're a big believer in gas, and it being an important transition fuel in terms of the move to a lower carbon economy. We're also invested in some of the critical or emerging critical minerals. Lithium and Pilbara Minerals is a key play there. And just lastly, I'll just call out Worley as a service provider, particularly in the renewables space. Worley's invested $100 million into this renewables, and we see strong growth path going forward. Just lastly, just on the essential services and infrastructure, it is a mixed bag around that essential services, but we particularly like fibre networks, Chorus being a type of monopoly type operator in New Zealand. It's effectively the NBN in New Zealand. We see fibre is very defensive, very sticky, and almost an essential service for most households these days. Next DC is another one where in the data centre space we're particularly like, and I think we might get into this in question Q&A, but it's clearly data centres are clearly a beneficiary of the AI and the explosion in data consumption. Just lastly, around healthcare, there's a number of names there that we like, which we see as defensive, which have got good structural growth themes. CSL in plasma, Pro Medicus, which is a fascinating company. It's been one of, I think, Australia's great unspoken sort of or underrated success stories. And then ResMed on the sleep apnea side, again, very defensive and sort of an undeniable trend, I think, in terms of the take up and growth, sort of mid-teens growth in sleep apnea. So I'm going to leave it there and happy to move back to Brad.
Yeah, thank you so much, Hamish. There's a lot to unpack there, and so members of the audience, please feel free to use the Q&A button and enter your questions. There's a few coming in. So, gentlemen, you both, as specialist managers, you both have the ability to sift through the universe of stocks and invest aligned to mega trends and your expectations of the future. Hamish, the graphic that you put up, your portfolio looks very different to what a passive investor would hold. And so could you just give some kind of description about expectations for an investor in your portfolio, performance relative to a passive benchmark, and what degrees of out and underperformance and over what periods of time does that occur?
Yeah, sure, Brad. So you're right, we are high conviction investors. Typically our portfolios will have somewhere between 20 to 40 stocks in them. And they look very different from the benchmark. So we have periods where we will underperform the benchmark and periods where we will outperform the benchmark. But what we seek to do is outperform the benchmark over the medium term. We target 3% outperformance to the ASX 300 is our investment objective. And in terms of returns, being a high conviction investor, our turnover is somewhere in the vicinity of about 50 to 60% per annum. So part of our return will come from realised gains, which will then be paid out in distributions and income. So the return between income and distribution, or capital gains, I should say, is probably about 50-50 historically.
Yeah, that's a great answer. Thank you, Hamish. And Monik, you touched on NVIDIA, which has been in the headlines recently for joining the 1 trillion market cap club for a few days, and it's still hovering around there on the back of AI-related chip demand. It comes at a PE multiple, I think, in the order of 40 to 50. So how do you reconcile valuations of this sort with trying to position your portfolios in a way that capitalizes on potential megatrends?
Brad, that's an excellent question. I think there's two aspects to it. One is it clearly is a mega trend, and investors really do need to embrace it because it's accelerating at a rapid rate, and it's already starting to have a profound impact. And I think we're starting to see companies announce strategic investments and even, unfortunately, job redundancies because they recognize they can do and manage businesses more efficiently. So in terms of how do we reconcile, valuations are always important. And with NVIDIA, it is right at the heart of the AI revolution or megatrend that's occurring. But having said that, there is a lot of embedded growth already expected in the current share price. So based on our modeling, looking at it slightly differently, we kind of reverse engineer to try and work out what the market is expecting in terms of future growth in the current share price. And our modeling shows it's expecting growth rates of 20% plus for the next 13 years. Now, it is achievable, but very few companies have done that. And when they started, the share prices can fall quite significantly. So whilst it's at the heart and center of what's going on, certainly from our process perspective, valuation does get in the way, and we did hold it, and we did exit it largely because there was already a high level of expectations already built into the share price. But there are other opportunities out there where you can buy businesses with sustainable growth, where the expectations are nowhere near as high as NVIDIA. Let's take Adobe as an example. The expected growth there is around 10 to 11% for the sort of the next 10, 12 years. And the company's been growing, at the mid-teens sort of high mid-teens rate, not only for the last 10 years, but expected to grow that rate going forward. So companies like Adobe and Microsoft, and we don't own all the big tech, by the way. There's a lot that we avoid because we think they could get disrupted. But there are opportunities there to invest and invest at attractive valuations.
Thanks, Monik. And there's another one for you. Vanguard has a 10-year outlook for US equity return prospects of 1 to 2% per annum, preferring other markets very materially. Do you agree?
Another excellent question, because I would suggest that Vanguard would probably held a similar view, not Vanguard's fault. It's a consistent view that the US would underperform other markets, and it's probably been in place since 2017. And I think investors are too busy looking at aggregate earnings and not really understanding the structure of the markets and the changes that are happening in the global economy that I think we're all aware of now. So if you look at a lot of markets out there, they're full of cyclicals and economically sensitive stocks, and stocks that really aren't benefiting from those trends that we spoke about, that are delivering those sustainable high levels of growth. So there are many parts of the US market that probably won't perform very well. I would probably agree with that. But we've got a global mandate, and we can go and find a company anywhere to invest in, and valuation is an important consideration. But what we do is we look for the businesses that are best positioned to take advantage of those secular trends. And I mean, they're best positioned companies. They're the ones who are going to take a large slice of the growth that's coming through and also deliver high levels of profits. And every time we do the work, based on quality, positioning, and valuation, it keeps on taking us to the US, and it's worked. And again, the last 6 months is a good example. A lot of investors were selling the US down. I've heard they've gone into Europe, into emerging markets, etc. And I think they've been caught out again, because here we are in the middle of the AI trend, and there will be bubbles within the AI trend. I do acknowledge that. We've got to be very careful, but it is a real trend. And by being underweight the US, you've actually missed out on the companies that had been beaten down last year, that were extremely well positioned and are now harnessing that, and it's coming through in their earnings numbers.
Yeah, thank you. And yeah, for what it's worth, I think it's a brave investor to bet against the US, especially in an era of, you've got global champions, many of them are US-based companies, and there's close to monopolistic pricing power for companies like NVIDIA in the tech race and the AI boom. and perhaps traditional valuation metrics that Vanguard are leaning on are not as applicable. And overall, it's probably a better stock picker call than a country by country call. But following on from that, there's a question here for Hamish. Hamish sounds more cautious on the macro outlook. Do the presenters agree then that offshore equities are more attractive? Maybe we could just elaborate on that prior conversation, Hamish.
Certainly, good question. We are more cautious. We think that financial conditions are going to be tightening, but my point really is that it's going to be an uneven economy, and there's going to be, I think, opportunities. Despite some parts of the economy, I think will feel as if they're in recession, and other parts, I think, will continue to prosper. And some of those themes that we highlighted are areas where we certainly think there's good opportunities. So I spoke to some of those structural and secular issues around the energy transition. Australia is one of the best placed countries in the world in terms of suppliers of future-facing commodities. The lithium, also we've got some big copper reserves as well, which are important in terms of batteries. Also, a number of our companies are global businesses. So the likes of Worley's a global business, 40,000 employees around the world. The leading, I think, contractor to the energy industry for probably the last 15 years. But that company is pivoting to renewables in a very material way. And the Inflation Reduction Act in the US is provided a great entree for them in terms of companies, which I think were previously looking at various projects. On the back of that, the IRA Act, are now committing capital and making decisions and investing. And that's benefiting companies like Worley. Some of those other healthcare companies I spoke to, Cochlear, CSL, Prometheus, they're global businesses which have got very strong competitive advantage on products, which makes them global leaders in what they do. So I do think there is still opportunities despite the economic issues in the Australian economy. It's about being selective though, and active.
Yep. Thanks, Hamish. Now this one's quite niche. Apologise if it's too niche. But on policy and competitive advantage, I'm thinking of BHP when I read this question. The US is seeking to de-risk from China in areas such as advanced technology on national security grounds. Similarly, China is trying to de-risk itself from the US and its allies, for example, by reducing the amount of iron ore imports from Australia and becoming more self-reliant. This is a policy of China's. Are you familiar with this policy, and should Australian investors be concerned?
Do you want to have a go at that?
It's a big question.
Who's the question for? I think
it's for whoever. I guess, is it a credible threat in your eyes that China could feasibly reduce its iron ore import reliance from Australia?
Well, if you're happy, I can go first, and Hamish, perhaps you can follow. It is a difficult topic and quite broad, and who knows what's going on in Xi Jinping's mind at any point in time, and the team around him. Look, I think broadly speaking, the trend's very clear. So yes, we're in a very different polar world than we were before. There's no longer utopia, so yes. But the real question is, there may be a desire to do that, but can you actually do that? Can you achieve what it is that you're setting out to do? So Hamish is certainly an expert on Australian equities, and I'm more on global, but certainly in terms of iron ore, well, if you're looking for the highest quality iron ore, I know coal's a bit dirty, but the Chinese are still very reliant on coal, etc. Well, there aren't too many places you can go to get that quality and that certainty, apart from Australia. And in terms of technology, I mean, I think what the US have quite clearly shown, which is why some of the US stocks have performed very well, because part of it is geopolitical, is an appreciation that they are basically the leaders in those advanced technology areas. And, maybe the Chinese can catch up, but certainly the work we're doing shows that there's a very, very significant lead time before they can achieve and get to the level that the US are at, in some of those technological areas.
So I might just add to that. I'll go back to sort of some of the opening comments I made around geopolitical risk and so forth. I do think that we are moving to this world of sort of alliances and supply side resource security is an increasingly a strategic issue for governments and countries. And be that around chips, be that around rare earths, which go into chips, be that around lithium, be that around iron ore. All these things are critical metals or critical inputs for the modern day economy. And so there will continue to be tensions around these things. I think the ability of China, I am aware of the policy, and China is clearly investing quite aggressively in the Simandou operations in order to try and build another world-class iron ore facility. I think you do need to remember that these take a long time and are very complicated. It might seem like a very simple business, but logistics and the history shows that these operations take a long time to develop and get to into production. That said, it may be achieved, and with that there is some risk that demand for iron ore, for Australian iron ore, might decrease. But I think the thing that we look for in commodities is where you sit on the cost curve. The only competitive advantage you really have in the commodity game is where you sit on the cost curve. And Australian producers are at the bottom of the cost curve and will remain at the bottom of the cost curve, I think, based upon the numbers at least we've seen on that Simandou operation. And so that is your competitive advantage in a commodity world, and it's hard to displace. So perhaps I'll leave it at that.
Yep, thank you, Hamish. This is for whoever would like to respond. Bonds and term deposits are now offering good yields. Do you see equity returns as being superior returns?
Well, I'll certainly, I think for the investor, it's certainly a much more attractive environment to be in because, prior to the rise in yields, unfortunately, there was only one game in town, as you say, Tina. There is no alternative. So I think it's a really healthy environment for investors to get a much better balanced return going forward. And I think that's an important word I use because there's obviously a place for each of those asset classes in a total portfolio. Obviously, not my job, but depends on the individual investor and obviously their investment requirements, investment objectives, etc. in the coming years, investment needs. So I think it's fantastic because the other attribute that has just come through is that clearly when rates became very, very low, a lot of what I would call lower quality businesses got very extended valuations, and there was a bubble there, you could argue, right? And particularly in unprofitable growth stocks, particularly one area. And so I think what this does is it really allows those businesses that can thrive in any interest rate environment, if I can put it that way, to continue to sustainably grow their earnings. So in terms of equities, yes, I mean, they have delivered 9 to 10% kind of compound returns over the very long term. And that's because unlike bonds and cash, they reinvest in the business and their earnings grows every year. So you're getting, and then depending on capital allocation, they either reinvest or they pay increasing dividends. Your total return potential continues to be very attractive. So I would argue for the right type of stocks, it is still an attractive environment to be in equities. And I certainly wouldn't advocate suddenly selling down your equities to buy bonds and cash, because you actually may end up with a return that doesn't meet your desired objective.
Thanks, Monik. So are you happy with that, Hamish?
I don't have anything to add. I think it's a good answer. Yeah.
So we've got 2 questions to go, unless any others come in, and 5 minutes to go in the time for today. Other than data centers, are there any other Australian plays on the AI boom?
Look, there's data centers is an obvious one. I mean, Pro Medicus is one that actually has some AI technology. They've been working on it for the last couple of years, which they're looking to roll out later this year. I think there's no direct exposures clearly in the chip space. I think the broader area, I think, for Australian companies is going to be where they can leverage actually AI for productivity and efficiency gains. And I think that is still sort of quite embryonic. But clearly there's been a lot of, in our discussions with companies more recently, there's talks about how they can use it in sales and marketing, in building, automating and building better their sales channels. And so there's a lot of companies focused on it. There's a lot of companies talking to it about being a big cost out driver. I guess we'll have to see, and clearly for companies that are more labor oriented, maybe there's the opportunity for that going forward. But I think it's a space that's very hard to quantify at the moment. But those 2 that I've mentioned around sort of data centers and Pro Medicus, the 2 in the portfolio which we hold, which we see as sort of direct AI beneficiaries.
Thanks, Hamish. I think this will be the last question for today. Monik, is there a global trend you are avoiding, one you think is not sustainable?
Oh, what a good question. We're always looking for trends that are sustainable. So I think caught me on the hop there a little bit. Let me have a little think. Is there a global trend? I mean, there's always lots of fads and themes around which are shorter term in duration. And I think quite often, actually, perhaps a slightly different way of answering the question is sometimes you can be very early onto a trend and it seems very exciting. But what happens is in the early stage of a trend, there's a lot of excitement and a lot of investment goes into it, becomes too competitive, and the returns aren't there for investors for quite a period of time. So, there's lots of examples that over the last few years, things like, we've avoided, even though they're very attractive areas from a thematic perspective, but things like solar and wind, were areas we avoided because there was so much competition there. And then even in the early stages of the development of electric vehicles and batteries, again, seemed very exciting. And then the profitability wasn't there, so they got hit quite hard. So it's more sort of, understanding where you are on that trend and when to get involved. And typically in the early phases of a trend, you get what's called the hype part of the trend. And there's a lot of excitement. You could argue AI might be like that, and there could be a lot of areas you want to possibly avoid as that starts to evolve and really be quite selective. So perhaps a slightly different way of answering the question.
Right.
Look,
thanks.
Thank you very much. So to Monik and to Hamish, thank you very much for your really interesting insights for this first webinar to start us off in thinking about where we are now and what the markets might hold for us over the next 6 to 12 months. Let me just remind you that coming up for IMAP, we've got our Advice and Action Conference in July, accompanied by the Masterclass and Independent Thought in September. And of course, on Wednesday and Friday of this week, we'll be looking at those 2 other really important asset classes, fixed income, and haven't rates really determined the outcomes for for all the investing classes. And then on Friday, physical assets and infrastructure, that area which is of real interest to advisors as they think about putting together portfolios that are appropriate for retail investors in the absence of the sorts of funds that the industry funds can deploy. So I'm looking forward to that. I'm looking forward to Brad joining us again as the moderator for our Wednesday and Friday sessions. So thank you very much to today's panelists, and we'll look forward to all of you joining us again on Wednesday and Friday. Thank you very much.
Thank you.